Hmm. Oh, is it time to do another Q&A video?
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, answering more of your stunning questions about mortgage and real estate financing. I really enjoy what I do for a living, and I'd love the opportunity to help you with a home loan, whether I can help you in the states I'm licensed, which is Utah and Nevada, or help you with any questions you might have anywhere. I really enjoy helping people. I really enjoy answering these questions and seeing where I can help you get into real estate. Homeowners win in the long run, so it's time to be a homeowner. Don't wait. I know the market's changed. I know interest rates are worse. I know everybody's saying, oh, what a bad time to buy real estate. It's not a bad time to buy real estate. It's not the best, but it's not the bad time. There's still way more benefits to owning a home than paying rent. So let's answer a couple questions today. I like to keep these videos to about 20 minutes or so. So let's see how many we can get to. If you have any comments, questions, or things you'd like answered, please submit those in the comment section and I'll get to them in a future video. So let's just dive right in. I thought this was an interesting one. If there is no mortgage, can a bank foreclose? No. The lien against the property is what they would foreclose on if you don't make your payments. So if there's no mortgage, if there's no debt owed, the bank can't foreclose. That doesn't mean that the properties don't get seized by taxes or HOAs or other ways the property does get taken away. But in this specific question, a bank can't foreclose on something if they don't have a lien against it. But that doesn't mean the property is safe from other ways of taking the property back, bankruptcy or a trustee sale, or not paying child support, or not paying the property taxes, not paying your HOA. There's other ways the asset could get taken away, but it wouldn't be a foreclosure in that situation, and it wouldn't be a bank trying to foreclose on it. Now, you might have a judgment. I mean, there's lots of reasons why people can go after your property, but if there is no mortgage, then the mortgage company wouldn't be able to foreclose on the property. All right, what else we got here? Let's see. Let me get to the right screen. Let's see. What happens to your home if you retire before you pay off the entire amount of the house? So the payment's still due. So just because you retire or one of the people passes away, let's say there's a husband and wife and the husband passes away, the wife passes away, the mortgage is still there. It's still secured against the property. Just because your situation changes doesn't mean the bank then says, oh, well, you've been making your payments for 10 years, even though we have a 30-year loan, you don't have to make your payment anymore. It doesn't really work that way. So as you're getting ready for retirement, that's one thing you need to consider is that mortgage payment will continue forward unless you refinance, do a reverse mortgage, do something else before that. But here's something I would tell you as well. Trying to quickly accelerate paying off the loan just so the mortgage is gone isn't usually the best way to do it versus paying off other debts so that you free up your budget and you set aside the money to pay the mortgage. I have a lot of people that'll sit there and they'll do everything they can to have the house paid off for 5 years and have nothing in the bank. They have all this equity now they can't get to without selling or refinancing versus having that money in the account that can help make the payment. So if you are retired, if your parents are going to retire, if you're concerned about the mortgage, let me show you some strategies that may be able to give you a little more peace of mind as you enter retirement. There may be a reverse mortgage, there may be a new mortgage we can do, but a lot of times it's more an issue of cash flow, having enough money in the bank to cover the payment instead of taking all that you have in the bank to get rid of that payment. I'm telling you, having that payment cash flow is better than having all this equity you can't get to or liquidating all your savings, your retirement, your 401, whatever it is, to get rid of that monthly expense. There's a balance, and I really want to run those numbers for you or your family member to be able to kind of give them a little more peace of mind than just saying, I've got to get mortgage free or I've got to get rid of the mortgage payment. So, love to talk to you about that. I've helped a lot of clients have some peace of mind when it comes to entering retirement while still having a mortgage loan. Let's see. Are there any places in the world where people can own homes without paying property taxes and mortgages? No, at least the property taxes. So property taxes are regardless if it's free and clear. That is depends on the state you're in. Some property taxes are less or more depending on the state you're in. But once you own that real estate, there's usually a tax with it, regardless if it's free and clear or regardless if you have a mortgage. Next thing is there places in the world where you can own a home without a mortgage? Sure, if you have enough cash to pay cash for it or be able to accelerate the payment to get rid of it. But I'll tell you this, having a mortgage is one of the better debts to have because it gives you the better rates, the better terms, a locked in 30-year payment, where a car loan, a Visa, or something like that typically has a higher interest rate. and you can put more money towards that quicker. So all you have is a mortgage. So obviously, I'm in mortgages. I sell mortgages. I leverage mortgages as much as I can on my real estate because it's such a great leveraging tool to buy more real estate to be able to do it. So it's not an evil. If you use mortgages correctly, they're an incredible tool, a fantastic wealth building tool if you use them correctly. But it is something where no, you don't have to have a mortgage to own a home if you have enough cash, but you will have property taxes. I don't know anywhere where you get rid of it. Now, maybe there's some senior programs where if you reach a certain age, they'll subsidize or reduce what you owe on property taxes. Veterans, I know there's some programs out there depending on the county that you're in, but generally speaking, you're going to owe property taxes on any property that you own, whether you have a mortgage or whether it's free and clear. All right, let's work on the next one. Does having a mortgage debt always mean you have a negative net worth? Absolutely not. I mean, most of the time, the mortgage debt's less than the value of the home, and you have more of a valuation of the home going up in value than if you're not a homeowner. So, no, having mortgage debt does not mean you're negative value because most cases, especially over the last few years, the value of the home is way more than what the actual mortgage is. But look at it this way, the mortgage payment's way more locked in than rent, and it's something where the rents can change based on the landlord, based on the new landlord that buys the property, based on whatever changes for the landlord, what the market's doing. It's much more volatile than a mortgage payment. Mortgage payment's a 30-year fixed mortgage. The only things you really see that change on a mortgage is going to be maybe property taxes, homeowners insurance, HOA, those things. And generally, they don't move a crazy amount. Now, there might be some big school being built, or there may be something where the taxes do go up, but generally, they're very small incremental changes versus rent just going up like crazy. So I don't know anybody, even during '08 when there was people getting underwater on their homes, they still had more of a positive net worth if they wrote that out. And most everybody, especially now, owes way less than what the home is worth. So no, it does not negatively affect your net worth. If anything, it increases it. Let's see. What is a new way of determining risk while underwriting mortgages? What is a new way of determining risk? So there is a guideline for everything. There's an underwriting guideline that determines the risk of the file, but really there's four major categories that underwriters are going to look at. Ability to pay the loan. So this is debt ratio, where your income's coming from. Credit score to show how you've managed your bills, how you've managed your debts, how you've managed your credit profile. The type of property. So whether it's a single family residence, manufactured home, a townhome, I mean, all kinds of different structures of building in, and then the property use. So this would be something whether it's a primary residence or a second home, like a vacation home, or a investment property, like a vacation rental or something like that. So those are some of the biggest risk determiners. But I tell you what, the guidelines, there's something for everything over years and years and years of doing mortgages. They've created a guideline for just about everything. There's very few times where there isn't either a catch-all guideline that catches everything or has a specific guideline for every situation that's been out there times a million. I mean, there is amazing amount of guidelines out there. And some programs say no to certain things and say, okay, if you don't fit this guideline, you don't fit this program. Where other lenders say, hey, we'll take on the risk of that file by offsetting it with interest rate or down payment or credit score or something else to offset the risk. So a lot of times you'll see, a lot of strongs in one area that's weak. Those strengths can offset it, or it can be something that completely turn down the file. I've had so many people, I have a 900 credit score. Well, if you have a 80% debt ratio, I don't care if you have a million credit score, you're not getting the loan. So these are kind of equal, but they do have a chance to say, okay, we're weak in this category, but we're stronger here, and it can help offset the risk. But if it's all risk, that's where you're going to get higher rates or just get flat no's on your loan. So part of my job is to review the client situation and know which lenders will take that file or what we can do to strengthen the credit profile to where they do get the better loans. If we have time to work on that stuff, it can make a huge difference on getting you a better loan. Let's see. If Bitcoin became the only currency, would there still be mortgages? Absolutely. Absolutely. In fact, I'm starting to see stuff in the digital currency world where you can borrow against the digital currency. So there's always going to be some sort of lending. Lending has gone back to the days when money was first created. There's always been a system of being able to say, well, I don't have the money on me to pay for that thing, but if I can spread it out over 60 payments or whatever, then I can make that money. And there's always going to be somebody that wants to make the interest on that. There's always going to be some form of lending on homes or lending in general, even if it goes to digital currencies, because people don't have the money to be able to do this. Now, obviously, Bitcoins have gone up. If you got a bunch of them, the value of it's gone up to where now maybe you can cash them out and just buy a home with it. But even if some digital currency takes over, I guarantee you there's going to be some form of lending on any currency that exists. That's how it's always going to work. There's always going to be somebody that needs money and always somebody willing to loan it with a percentage added to it. There's always going to be that situation. Let's see. Is a $50,000 down payment a good down payment for a $350,000 house? Yes. Keep in mind with your down payment, you're also going to have closing costs you're going to have to cover on top of the down payment. So if you have 50 grand, not all of it's going to go towards the down payment, most likely. You will have some closing costs as part of your purchase. Now you can build that into the price. So you say, okay, in this scenario, I'll offer you 350 for the house if you give me 10 grand back to cover the closing costs. But $50,000 down or 50,000 to work with to cover down payment and closing costs is a good down payment. But here's something to consider as well. Most down payments are on 5% increments. So you don't really gain a benefit to say putting 7% down or 8% down. You're better off to go back to 5, take that difference and maybe pay off another debt or just keep it in savings, keep it in reserves, than putting it down on the house. Because an extra 10 or 15 grand on the house is not going to really move the payment all that much, but having that money to pay off another debt or have that payment just to give yourself a little cushion will be better when you're really not getting a rate difference because you're in those 5% tier. So it's either 5% or 10%. There's really no reason to put somewhere in the middle there. And again, make sure you have your down payment, your 5% covered, plus the closing costs, either that you're bringing in or that's just built into the price. And I've run the math 1,000 times, a million times probably, that it's better off to build it into the price. It really is better to even raise the price to say even 360 and get that $10,000 back than having to bring the $10,000 to the table. There's just better places to put the money, frankly. Having in your account for rainy day, emergency, expenses. Maybe there's something with the house you want to do. When you move in, there's going to be little things you want to add, maybe blinds or landscaping or furniture or something that you want to add to the house. So just having a little money behind it's better than borrowing even more money or being able to use that money to get rid of another debt. If you got a $10,000 balance on the car loan that's $400 a month, I guarantee you 10 grand on the house isn't going to save you 4 grand or $400 a month. So there's better ways to use the money than all down payment once you start reaching the minimums. One other thing I'll say on this, we're getting a little soapbox on this one, is a lot of times you can also buy out the mortgage insurance. That money used for that goes a lot further than putting the same amount down. So really look at that option. Look at the option of buying out the mortgage insurance. You can't do it on FHA or government backed loans, but on conventional loans, there's options to just get rid of that monthly expense instead of buying down your rate or instead of putting the extra money down on the loan, you can actually get rid of that expense. That's one of the best ways to use the money. So if you want more details on that, I'd love to show you how those programs work and how to maximize the money you have for down payment and just see if you can get rid of other debts. So I had a similar scenario where the clients, by getting rid of other debt, they were able to afford more home because now they freed up the budget. So instead of looking at a home at 350, maybe they're looking at a home at 4 or 450 that opened up three-car garage or landscaping or closer to the areas they wanted to be by getting their price range up a little bit. That's a huge tip, a great tool of getting rid of the mortgage insurance, paying off some other debt and putting less money down on the home can actually help you afford more home. Get into a home that you actually want that can be a more of a long-term home, more the home that you actually want. So this is why it's important to get pre-approved, to run these numbers, to find out what you qualify for. I still have so many people that call me and say, "Oh, I got to say wait till I have 20% down." Like, why? You can do it with 5% down. And you'd have a cheaper payment than putting 20% down if you structure it correctly. So check out my website, ryanbolton.com. There's a little scheduler on there. It's got my phone number. Call me with any of these questions and I'll help you walk through your situation to see if you're getting the best loan. All right. They got a little ad. I mean, this ad is sponsored by. I love this stuff. It's so much fun. Okay, let me go back to the questions here. How are we doing on time? 14 minutes, a little over 14 minutes. Okay, I try to keep them about 20 minutes or so, just because I think that makes more sense for people to watch the video and still make it fun. Let's see. All right. Can I use an LLC to purchase a property using an FHA 203K loan? No. FHA loans, And most real estate loans that are FHA are going to be a personal loan. They're not going to be to a business. And it's something where they want to do it to primary residences of the actual owner. So FHA won't allow you to do an LLC. Now you can move the property, the asset into the LLC by a warranty deed, quick claim deed, that type of thing. But no, the loan would not be done in the name of an LLC. And a lot of times that's people trying to fix and flip. Honestly, that's where they're getting that 203K loan with an LLC and then flipping the property. That's not what that loan's designed to do. It's designed to be for people owning primary residences. Let's see. Can my lender change my loan terms after I've signed and closed on my house? No. So once it's signed and recorded, that's a particular term there, not just closed or signed the paperwork. It has to be funded, recorded, keys are in your hand, that type of thing. You actually have to be the owner of the home. After that, the note is locked in. So if another lender purchases it or the loan gets sold or transferred or servicing changes, they cannot make any changes to the loan. Now, I see this pop up when people see a big change in their payment because of their taxes and insurance. They all of a sudden get this notice, hey, your payment's going up $100 a month or whatever it is. A lot of times that's a change to the property taxes and insurance, not to the note or the interest rate that you're paying, unless it's an adjustable rate mortgages, which are pretty uncommon. There's not a lot of adjustable rate mortgages out there. Um, They've gotten a little more popular as rates have moved up, but it is something where over the last 5 years, I don't even know the percentage of ARMs or adjustable rate mortgages that have been closed. So the shortest answer to this question is no. Once the loan's done, locked in, recorded, any lender that is buying that note or consolidating the servicing, or a mortgage company just closes and another mortgage company buys their assets, it is something where they don't have the right to change the terms of the loan. The only thing that would change on it is taxes and insurance. All right. Ooh, 16 minutes. I try to keep it like 20, so I try to keep an eye on the clock here. And again, if you have any questions, comments, post them. Love to have a chance to work with you, or call me if you have any questions about your specific scenario. I'd love to help you with a mortgage loan. Let's see. How long does it usually take to hear back from a lending company once your loan application is sent to underwriting? Your loan application usually doesn't get sent to underwriting until you have more of a full file. So there's usually appraisal by that point, title report, homeowners insurance, pay stubs, W-2s, tax returns, whatever it is that you need for income. So usually it's a little bit more of a package before it goes to underwriting. So there's usually a processing stage. This is where we're verifying where you work, getting your pay stubs, W-2s, getting the source of the down payment, gathering that all up with the processing team. Then that file goes into the underwriting team. And I would say most companies are between 48 hours to 72 hours. I would say that's been common. Now, as staffs have been cut back, as mortgage companies have seen their volume go down, I've actually seen those turn times kind of extend a little bit. But generally, I would say an average probably 72 hours. I've seen as quick as 48 hours, same day kind of thing. But I would say generally plan on three days. If it gets more than that, then either the file's not been submitted or it's not as complete, or that particular lender is just really, really busy, or they're stalling with the processing team. I mean, there's all kinds of different things. Once it's done with underwriting, it goes into the closing department to actually issue the closing documents. And sometimes they'll do some double checks on some things that may have expired. It's kind of a last little check. Then that's when the documents go to the title company. So you kind of have application pre-approval stage, processing verification stage, underwriting stage. Then it usually goes back to processing for any final conditions, back to underwriting to get cleared off, then the closing team, then it's over with. So the loan officer's job is to help it walk through all those stages to make sure that it's just as smooth as possible, because you really don't want the file going to underwriting until it's gotten a lot of that stuff done first. But there is times where you want to send it in to see if the underwriter will take what you have or see what conditions they'll add to the file. So there's all kinds of processes we do depending on the client. But that's my job, is to kind of orchestrate, keep all these plates spinning in the air and keep the file moving on the deadlines, and make sure that the program we're submitting to should follow the client's needs. And that's kind of the whole step. So how long does it usually take? I would say 48, 72 hours, somewhere in that range. And it is business hours, so not weekends usually. So it is something usually about 72 business hours, I would say, is pretty close. All right. Oh, we can squeak one more in. We can squeak it in. Unless we get on a soapbox again. We've done that. We've been known to do that before. Am I right? All right. Let's see. Let's see. Would I get questioned if I keep paying my mortgage with cash? Possibly. Depends on the mortgage amount, but generally speaking, you got to get, I mean, unless you're going into the bank directly to make the payment, I think it's rare that you're going to see You're not mailing cash into the mortgage company, so it really depends on the mortgage company. But that can be a red flag a little bit if they're just cash that kind of just keeps showing up in your account. They're going to wonder where it comes from, especially if the dollar amount's higher. So that's just a money laundering type thing. When it's funny how it's the world's kind of got a little anti-cash in a sense when it comes to this type of stuff, that they just want it all just kept kind of in the bank and to just be wires and checks and stuff like that. But it can be something that can cause a problem depending on the amount and how you're making it, either through your bank and then transferring it or directly bringing it to the mortgage company itself. So let's say we can squeeze one more in here. Let's see. What are the risks of flipping homes if you have an FHA mortgage for your primary residence? You can sell your property after an FHA, but if you keep doing a new FHA every couple of months and flipping it, that's when they're going to start questioning whether it's really a primary residence. Usually it's a 6 month window. I've seen as much as 12 months before you can get another FHA loan. So it isn't really designed to be something where you keep buying an FHA mortgages and then doing it, but it is something where you'll run the risk of just not getting approved. There'll be another case number and they may just deny your ability to get another FHA loan. They're not really in the business to help you fix and flip. That's not what the FHA loan is supposed to do. It's designed for primary residences, and that's it, to help you purchase primary. It's not just designed for first time home buyers, but it is designed really for primary residence financing, not investment or portfolio building or fix and flips where you can remodel and sell them. You've got to keep them for, I'd be safe on 12 months. You can get away with 6 months, but generally speaking, you got to keep it a year and then you can sell it, buy another one, keep it for a year, sell it. That's totally fine. All right. I think we're out of time. Oh, I can hear everybody out there just going, man, we were having so much fun. I know. I know. You know what? I'll make some more videos. You'll be fine. If you have questions, submit them and I'll get them on the next video. So then your question might be answered by the mortgage nerd. I don't know what could be better on a Tuesday afternoon. What day is it? I don't even know what day it is. Well, I don't even know what day you're watching this. So, but can you think of anything better than submitting your question and having it answered by the mortgage nerd? Hello, man. If there's something better, I just don't know what it is. So if you need help with the mortgage, check out my website, ryanbolton.com, whether I can do the loan itself or just refer you to somebody. I'd love the opportunity to work with you on a mortgage loan, answer any questions you have. Please comment, click, subscribe, all that fun stuff, and we'll see you on the next video. Thanks again.